Most people believe that saving money is the responsible, smart thing to do. And honestly, they're not wrong. Saving is important. But here's what nobody tells you. Saving money alone will never make you wealthy. In fact, if you've been putting money into a savings account and expecting it to grow your financial future, there's something critical you need to hear today. Because what feels like financial safety might actually be quietly keeping you behind. In this video, you're going to learn exactly how to take the money you've already saved and put it to work in ways most people never even consider. We're going to break down the specific steps that separate people who accumulate wealth from people who simply store money. And near the end, we'll walk through a practical framework you can start using this week, no complex finance degree required. Stay with me, because one of the strategies we'll cover today completely changed how thousands of everyday people think about money. Before we dive in, if you're serious about building real wealth, creating multiple income streams, and finally understanding how money actually works, subscribe to Wealth Forge right now and turn on notifications. Every single week, we bring you practical financial education, passive income strategies, and proven wealth-building insights designed to move you closer to financial freedom, one decision at a time. There's a woman named Sandra. She spent 15 years doing exactly what she was told. She budgeted carefully, avoided unnecessary expenses, and kept a steady amount growing in her savings account. By most standards, Sandra was financially responsible. But one day, she sat down and did the math. After 15 years of disciplined saving, her money had grown by less than inflation had quietly eaten away at it. She wasn't building wealth, she was treading water, working hard just to stay in the same place. Sandra's story isn't unique. It's the quiet reality for millions of hard-working people who believe that saving money and building wealth are the same thing. They're not. Saving keeps money safe, investing puts money to work, and understanding the difference is where everything changes. It reveals a truth that can quietly shape an entire financial future. The gap between saving and investing isn't just about where your money sits, it's about whether your money is standing still or going to work for you. Once you understand that difference, you stop seeing your savings account as the finish line and start seeing it as the launch pad. So the question becomes, how do you make that transition safely and intelligently? How do you move from simply protecting your money to putting it in a position to grow without taking unnecessary risks or feeling overwhelmed? The good news is that building wealth doesn't require secret formulas or extraordinary income. It begins with understanding a few timeless principles that have guided successful investors for generations. Let's walk through 5 practical lessons that can help you turn your savings into investments and your investments into long-term wealth. Lesson 1. Understand why savings alone won't build wealth. Here's something most financial institutions would prefer you fully understand. The average savings account in today's economy earns somewhere between 2 and 5% annual interest. Inflation, the rate at which the cost of everything from groceries to rent, runs right alongside it, sometimes even past it. What this means in plain language is that money sitting in a savings account is barely growing in real terms. The number on your statement may go up, but your actual purchasing power often stays flat or shrinks. The first step toward building wealth isn't earning more, it's understanding that your saved money needs a better environment, one that can actually multiply. The moment you grasp this, saving becomes the beginning of the wealth journey, not the destination. Lesson 2. Define your investment foundation. Now this is where most people get it wrong. They hear the word investing and immediately imagine complicated stock charts, high-risk gambles, or needing thousands of dollars to start. None of that is true. But before you invest a single dollar, you need two things in place: an emergency fund and zero high-interest debt. Your emergency fund should cover 3 to 6 months of your living expenses. That money stays in savings, liquid, accessible, and untouched. Why? Because investing requires time to grow, and if an emergency forces you to pull money out of investments too early, you'll likely sell at the wrong time and lose value. Think of your emergency fund as the foundation of a house. Without it, everything you build on top becomes unstable. High-interest debt, especially credit card debt, must be dealt with before you invest. The math is simple. If your credit card charges 20% interest and your investment returns 8%, you're still losing money. Pay off the expensive debt first, then redirect those payments into investments. Lesson 3. Start with what you know: index funds. Very few people ever realize how powerful simplicity is in investing. Once your foundation is in place, one of the most reliable and beginner-friendly ways to begin investing is through index funds. An index fund is a collection of stocks that mirrors a specific market index, like the S&P 500, which tracks 500 of the largest companies in the world. What makes index funds so powerful is diversification. Instead of betting on a single company, you're spreading your money across hundreds of businesses. If one performs poorly, others balance it out. Historically, broad market index funds have returned an average of 7 to 10% annually over long periods, significantly more than any traditional savings account. Warren Buffett himself has famously said that a simple, low-cost index fund is one of the best investments most people can make. When one of the world's most successful investors says that, it's worth listening to. Lesson 4. Automate to remove emotion from the equation. Here's where things become genuinely interesting. One of the biggest reasons people fail at investing isn't lack of money or knowledge, it's emotion. When markets dip, fear takes over and people sell. When markets surge, greed takes over and people buy at the peak. Both of those decisions cost wealth. The solution is automation. Set up automatic transfers from your checking account into your investment account on the same day every month, ideally right after you receive your paycheck. This strategy is called dollar cost averaging. You invest the same amount consistently, regardless of whether the market is up or down. Over time, this smooths out the effects of market volatility and removes the dangerous habit of trying to predict the right time to invest. The best time is consistently. Lesson 5. Diversify across asset classes. Pay close attention here, because this may be the most valuable lesson in today's video. Putting all of your investment money into one asset, even a great one, creates unnecessary risk. Wealth builders spread across multiple asset classes. Index funds and ETFs form the core for most people. Real estate investment trusts, known as REITs, allow you to benefit from real estate income without buying physical property. Bonds offer lower but more stable returns that balance the volatility of stocks. And for those at a more advanced stage, direct real estate ownership can generate both rental income and long-term appreciation. You don't need to invest in everything at once. The point is to think beyond one single vehicle and gradually build a portfolio that can grow in multiple directions, regardless of what any single market is doing. Before we continue, there's something important you need to understand. All of this only works if you stay consistent over time. The biggest enemy of investment growth isn't a market crash or economic uncertainty, it's impatience. The investors who build real wealth are the ones who keep going when things look uncertain. Here's exactly what to do next, this week, not someday. First, calculate your emergency fund target. Take your monthly expenses and multiply by 4. That's your minimum safety net. Once you have that saved, stop adding to savings and start directing new money into investments. Second, Open a brokerage or retirement account if you don't already have one. Platforms like Fidelity, Vanguard, or Charles Schwab make this straightforward. In many countries, tax-advantaged accounts like IRAs or 401ks allow your investments to grow without being taxed each year. Use them before anything else. Third, set up automatic monthly contributions with institutions that offers high interest rate, like 15% or more, even if it's just $50 or $100 or 500 naira to start. For example, in Nigeria, OPay have SaveBox or Target options that offers 15% interest annually. Consistency builds the habit and compounds over time. Then diversify 50 to 70% into high-yield assets like real estate, company stocks, business equity, etc. Fourth, research one low-cost index fund with a long track record and make that your first index fund investment. Keep it simple. Complexity is not an advantage for beginners. Fifth, track your portfolio monthly, but resist the urge to make changes based on short-term movements. Wealth is built in decades, not days. Let's bring it all together. Saving money is responsible, but it's not enough. Savings protect you. Investments grow you. The path from savings to investments starts with building your emergency fund, eliminating high-interest debt, and then systematically moving money into diversified investment vehicles. Start with index funds, automate your contributions, expand across asset classes over time, and above everything else, stay consistent. Every one of these steps is something you can begin acting on right now. Now I want to hear from you. Where are you in this journey right now? Are you still building your emergency fund, or have you already started investing? And if you have, what's the first investment you ever made? Drop it in the comments. Your experience might be exactly what someone else in this community needs to hear today. If this video gave you clarity, gave you a new perspective, or helped you take one step closer to understanding how money actually works, subscribe to Wealth Forge and turn on notifications. Our mission is simple: to help you build real wealth, create multiple streams of income, and achieve financial freedom through practical education and proven strategies. We're here every week. Don't miss what's coming next. Here's the truth that will stay with you long after this video ends. Income can make you comfortable, but assets that grow while you sleep, that compound year after year, that work even when you're not, those are what make you free. The savings in your account right now are not the destination. They are the starting point. The question is, what will you do with them?